Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary, filmed this week from our offices in St Paul's, London. In this session, I'm going to look at an issue that's dominated client meetings over the last few weeks, namely for how long and how intense will the current inflationary shock be, and what does it mean for market leadership and asset allocation. In a week where the US CPI has reached 5.4%, I think it's worth reaffirming what's driving these numbers. First of all, of course, a shock in energy markets, oil, gas and power. Secondly, problems in supply chains, meeting cash-rich consumers ready to spend after building up savings during lockdown. Third and finally, of course, base effects, which we hope will be largely transitory. What does this mean for policy? Well, first of all, it's already impacting the actions of central bankers. 9 countries around the world have already raised interest rates. Secondly, it's causing turmoil in the bond markets, with yields continuing to rise, another 20 basis points for UK gilts this week. Finally, it's putting a question above other asset classes, US growth stocks, private equity which uses leverage, even potentially property. And this has some quite big implications for how you should structure your portfolio. Let's look at this in the slides ahead. So let's look again at why inflation is rising. In the left-hand panel, I've plotted energy prices. Brent crude at $83, well above its high on the eve of COVID. UK baseload electricity prices tripling in the last 3 months, similar moves in gas prices. On the right, I've looked at supply chains, taking as a proxy the Baltic Shipping Index showing shipping costs. Look at that huge surge, meeting, of course, very cash-rich consumers who come out of lockdown with high savings and want to spend. Thirdly and finally, of course, there's base effects. This time a year ago, inflation was very low. What does this mean in a historical context? Well, inflation surprises are suddenly back with us. If you look in that left-hand chart, for most of the last 10 years, economists have actually overestimated inflation. Today, they're suddenly underestimating it. And that is causing central banks already to move. On the right-hand chart, I show the number of central banks raising rates against those lowering them. And we've got 9 central banks raising rates already, including Norway, Brazil, Mexico, South Korea, and New Zealand. And who would be next? Well, perhaps the first among the G7 is going to be the UK. And that's extraordinary, given that 6 months ago we were talking about negative real interest rates and possibly deflation. We're now talking about a rate rise, probably end December 2021 or into first quarter 2022. Look at CPI growth, expected to go above 4% for the remainder of this year and into 22. Real wages up at 3.4%. A very, very tight labour market. Look at those job vacancies, 1.1 million, a record number. And all this is causing markets to lift their expectations for UK inflation. Look at the implied inflation there at 3.8%. So what does this mean for asset classes? Well, let's begin with bonds. I plotted here for the last 50 years the 10-year US bond yield against core US inflation ex food and energy. And you can see that for most of the last 35 years, the bond yield has been above the core inflation rate. We've had real interest rates that are positive. Look at the position now with that surge in inflation. We now have real interest rates that are markedly negative. In fact, the most negative in the last 40 years. You have to go right back to the 1980s. Put another way, bonds look well out of line with nominal GDP. If you look at the position today, I've plotted a dot plot here for the last 60 years of 10-year Treasury yields on the x-axis and US nominal GDP growth on the y-axis. The position today is extraordinary. We're coming out very strongly with very strong growth in Q2 against very low bond yields. As that normalises, we hope we'll follow that blue line and settle somewhere around 2% bond yields and a 5% or so nominal GDP level. That's 1.8% real GDP and 2.5% inflation. But any error there, particularly to the upside in inflation, and you can see rapidly expectations for bond yields rise. So there's a lot of possible risk in today's bond market. One other factor to bring into mind is that the body that's going to be navigating us through this delicate exercise is, of course, the Federal Reserve. And they're facing a nasty personal dealing probe, which asks some really hard questions about governance of the Federal Reserve. At the Boston Fed, at the Dallas Fed, with the Vice Chair, even Chairman Jerome Powell, there has been trading by all of these individuals in bond futures, in bonds themselves, and in municipal issues around interest rate rises. This shows a Fed that's out of touch and possibly threatens Biden's renomination of Jerome Powell. If he didn't take him, who would be in? Lael Brainerd and Ralph Bostic, both highly capable, but with a more leftward leaning across the Federal Reserve. And of course, Fed leadership changes are always tumultuous. So what does this mean for equities? Well, you can see the effect on bond markets of this rising inflationary numbers. The UK gilt now down an extraordinary 8% for the year to date. World equities rolling over, not so bad, but equities down by 2% over the last month. Look on the right-hand side there, and that sharp correction in growth stocks, which of course like a low bond yield because they anticipate earnings going out across a long horizon, so that discount rate is important. Interesting equity volatility not as high as you might have expected. So let's wrap this up. Number one, we expect inflation to be sticky, but number two, ultimately for it to fall back to somewhere around the 2.5% to 3% level around the world. That's much higher than the 1.5% to 2%, which is probably broadly desirable for central bankers who want a deep and inclusive recovery. But for you, the investor, it puts real risks over the bond market. It asks some difficult questions about even private equity and property funded by leverage as interest rates rise. And of course, it means some big leadership changes in equities, which we hope our thematic process is ready to take up. Well, I hope that's useful. Thank you so much.